May 1982. The Treasury market was humming, the U.S. economy was tightening under the Volcker regime, and the federal funds rate was over 14%. On the surface, it looked like any other spring on Wall Street. Beneath it, though, the monetary system's core plumbing nearly failed, not from a sovereign default or an inflation crisis, but from a $285 million hole created by a second-tier broker, Drysdale Government Securities. Drysdale was barely known outside a tight circle of bond market professionals. But by exploiting a critical flaw in the way repos were structured at the time, it triggered a cascading failure that nearly destabilized the entire Treasury financing complex. What followed was one of the most underappreciated Fed interventions in modern history, and a quiet revolution in how U.S. collateral markets function. In 1982, the Treasury repo market was still a shadow of what it would become. There was no tri-party clearing, no margining standards and, crucially, no requirement to explicitly compensate lenders for the accrued interest on securities posted as collateral. Repos were structured like straightforward collateralized loans. You lent cash, received treasuries as collateral, and unwound the trade at a pre-agreed price. But the actual interest accrued on those treasuries was effectively ignored, creating a huge arbitrage opportunity. If you could borrow treasuries without compensating lenders for accrued interest, you could short them into the market and harvest their coupon value as if it were your own, a structural free lunch born of documentation laziness. Drysdale, with a razor-thin capital base, figured this out and scaled it recklessly, borrowing huge sums of treasuries, selling them short, and capturing the cash proceeds, with zero cost of carry. The strategy was only profitable if rates stayed in their favor, and only survivable if they never turned. Because the repo lender wasn't properly charging for the value embedded in the collateral, Drysdale was capturing unearned spread with each trade. In effect, it was converting the embedded value of the collateral into free cash flow. This only worked because the market failed to treat collateral with legal and economic precision. The collateral was technically still owned by Drysdale's repo counterparties, though Drysdale had temporary control and could rehypothecate it, even sell it outright, with no haircut, no margin and no interest adjustment. This allowed a small firm with almost no capital to raise billions in unsecured leverage, masked by the fiction that the trades were collateralized. By mid-May, the stock and bond trading firm had racked up positions totaling over $3 billion, roughly equivalent to $9 billion today, with almost no internal capacity to cover losses if the trade turned. But that plumbing cracked almost instantly once the market indeed turned. Rates moved against Drysdale. Interest payments came due. But Drysdale didn't have the cash because it had never priced interest into its borrowing in the first place. Worse, one of the Fed's primary dealers, Morgan Guaranty, now part of J.P. Morgan Chase, had been acting as Drysdale's clearing agent. Through a legal and operational loophole, Morgan had unwittingly guaranteed payment on every one of Drysdale's repo trades. When Drysdale defaulted, Morgan was left with a $285 million hole, over $850 million in today's terms, and the Fed was suddenly looking at the collapse of its primary dealer. Letting Morgan fail wasn't an option. The Fed had spent a decade rebuilding confidence in Treasury finance after the breakdown of Bretton Woods and the Volcker shock. To preserve that credibility, the Fed added bank reserves back to the system, ensuring Morgan could survive the loss. It was a silent intervention, a defining moment in the Fed's role as collateral system underwriter. It was at that point, it looked as if the Fed was changing its monetary policy into an accommodative interest rate target regime. Jeff Snyder, founder of Eurodollar University, had said in a YouTube podcast video published 3 years ago. The post-mortem on Drysdale exposed a staggering lack of standardization in the repo market. Interest wasn't being charged correctly. Margining was non-existent. Dealers operated on faith, not legal precision. It was a system built for failure, and Drysdale was just the first to press hard enough to break it. What followed was a wave of reforms. The Fed and primary dealers began re-engineering repo contracts to explicitly incorporate interest payments. That eventually led to the formalization of haircut practices, as well as legal documentation standards and the development of the tri-party repo structure. What we now recognize as the modern U.S. Treasury financing system, efficient, collateralized, margin-aware, was born in the ashes of Drysdale. There's a direct line from Drysdale to Solomon Brothers to LTCM and then eventually subprime mortgages in 2007, Snyder had said. When duration mismatches are bundled into repo, even small technical failures can morph into systemic risk. The Fed's eventual Drysdale intervention was a recognition that safe assets aren't inherently safe when the plumbing misaligns. As the chart shows, Fed funds rate was declining through 1982 because the Fed had already begun easing aggressively following the 1981 recession and Volcker's sharp disinflation campaign. But, at about the time of Drysdale's demise, the market began demanding more return for holding treasuries, even as policy was loosening, in a signal that something was structurally wrong. Drysdale was the dress rehearsal for 2008. Again, it proved that systemic risk all comes down to the plumbing. You can have the world's most liquid, risk-free collateral and still generate existential risk if the infrastructure underneath is rotting. It also presaged September 2019, when a technical liquidity crunch in repo briefly pushed overnight rates above 10%, once again exposing how fragile the Treasury funding mechanism can be when cash flow mismatches or operational risks are allowed to fester. But unlike 2008 or 2019, the Drysdale episode has been mostly erased from the market's institutional memory. Of course, that's a mistake. It was the original sin of modern repo, and it taught us that there is no such thing as a passive system. Every silent assumption in monetary plumbing eventually becomes a live wire. At the heart of Drysdale's collapse was the illusion that collateral was moving safely through the system. In reality, however, the firm was creating phantom liquidity, borrowing securities, then immediately reusing them in a repo chain without the proper haircuts. The lack of margin turned what should have been low-risk trades into leveraged bombs. And because collateral chains can stretch across dealers, desks, and time zones, each reuse of the same bond was a bet that no one would call the bluff. They were rehypothecating securities they didn't own, didn't haircut, and couldn't return. The system treated those bonds as good as cash, until they weren't. Drysdale was a mirror to how financial plumbing works when everyone believes collateral flows are clean and fungible. The money was fake in the most dangerous way, not because it didn't exist, but because everyone assumed it existed in multiple places at once.